Something doesn't feel normal in the silver market right now. It's not crashing. It's not exploding. It's just frozen. Price moves, but without conviction. Rallies fade quickly. Drops don't accelerate. Volume looks active, yet direction feels suppressed. It's as if the market is functioning, but not expressing anything real. And when a market that should be reacting stops reacting, that's when you need to pay attention. Because freezes don't happen randomly. They happen when pressure is being absorbed somewhere behind the scenes. Historically, silver has never been a quiet metal. It's emotional, volatile, reactive. It exaggerates moves. It overcorrects. It frustrates both bulls and bears. But what it does not normally do is go still during periods of economic tension. Right now, we have inflation uncertainty, fragile debt structures, geopolitical stress, energy transition demand, and persistent currency instability. In past cycles, that combination would have triggered aggressive moves in silver. But instead, we have hesitation. That hesitation is not necessarily weakness. Sometimes it's compression. In financial systems, when visible volatility drops during periods of elevated macro stress, it usually means one thing: adjustment is happening internally. The system is working to prevent external expression. Silver trades heavily in paper markets, futures contracts, derivatives, leveraged instruments. These mechanisms allow liquidity to appear deep and flexible. They smooth out spikes. They absorb demand. They create the impression that supply is always available. But paper markets rely on one critical assumption: confidence that physical settlement can be honored if required. If that confidence remains intact, the system functions smoothly. If that confidence weakens, behavior changes very quickly. A freeze phase often appears when participants hesitate to test the system. Buyers are cautious. Sellers are strategic. Large players reduce visible aggression. Everyone watches. It becomes a standoff. This is where many retail observers get misled. They assume that lack of movement equals lack of risk. But in reality, risk accumulates fastest when volatility is artificially low. Think of it like pressure inside a sealed chamber. As long as the valve holds, nothing looks dramatic, but internal stress keeps building. Silver has entered this type of environment before. In previous cycles, long stretches of sideways frustration preceded explosive repricing events. The market exhausted participants emotionally before it moved decisively. By the time conviction returned, positioning had already shifted. Right now, we are seeing several subtle signs as something has changed beneath the surface. The relationship between gold and silver is behaving differently. Silver's correlation to macro headlines is weakening. Reaction speed has slowed. Moves lack follow-through. That kind of behavior suggests one of two things: either demand has genuinely collapsed or supply conditions are tightening quietly while price is being managed through paper liquidity. If demand had collapsed, we would see broader weakness across industrial indicators directly tied to silver usage. But that's not clearly the case. Silver remains embedded in technology, electrification, solar expansion, and infrastructure systems that aren't slowing uniformly. So if consumption hasn't disappeared and investment interest hasn't fully evaporated, why does price feel stuck? Because price discovery may not be happening where most people think it is. When a market transitions into a freeze phase, it often means that large participants are repositioning without triggering visible disruption. Inventory flows adjust. Contract exposure shifts. Risk is redistributed. It's quiet, controlled, strategic. Until it isn't. The most dangerous market conditions are not the loud ones. They are the silent ones that create the illusion of stability while underlying structure changes. Silver doesn't freeze without a reason. And when something changes behind the scenes, the effects don't show immediately. They surface later and usually faster than expected. When a market enters a freeze phase, the first instinct is to assume nothing is happening. But in reality, this is often when the most important adjustments take place. Behind the scenes, positioning begins to shift. Large players reduce exposure quietly. Some roll contracts differently. Others tighten risk parameters. Liquidity providers widen spreads slightly but subtly enough that most participants don't notice. The surface looks stable, but underneath, flexibility decreases. Silver is especially sensitive to this dynamic because of how its market is structured. Unlike gold, which is held primarily as a reserve asset, silver exists in a constant tug-of-war between industrial consumption and investment demand. That dual pressure creates fragility. In a freeze environment, industrial demand doesn't vanish. It continues steadily, often invisibly. Manufacturers don't announce daily silver purchases on social media. They secure supply through contracts and long-term agreements. When availability tightens, they adjust quietly, increasing stockpiles, extending agreements, or paying slightly higher premiums without broadcasting it. That kind of behavior doesn't move headline price immediately, but it slowly reduces float, the amount of readily accessible silver available to absorb sudden spikes in demand. At the same time, the paper market can temporarily mask that tightening by expanding synthetic exposure. Futures contracts allow volume to grow even when physical supply doesn't, as long as most participants settle financially instead of demanding delivery. The illusion of abundance remains intact, but illusions depend on coordination. If too many actors decide they prefer certainty over leverage, meaning they want real metal, instead of exposure, the balance shifts. Not gradually, but abruptly. Freeze phases often signal that the system is adjusting to prevent that shift from happening too quickly. There's another layer to this. Silver historically exhibits a pattern of emotional exhaustion before breakout. The market drifts sideways long enough to frustrate long holders and discourage new entrants. Momentum traders leave. Commentators lose interest. Volume normalizes. Sentiment softens. This psychological reset creates the perfect environment for repricing because resistance decreases. When fewer participants are positioned aggressively, there is less immediate selling pressure once a move begins. Right now, sentiment towards silver feels cautious, not euphoric, not panicked, just uncertain, and uncertainty is fertile ground for surprise. Another key signal is correlation breakdown. When silver stops responding predictably to inflation reports, rate expectations, or currency moves, it suggests that internal mechanics are outweighing macro headlines. That's not weakness, it's insulation. Insulated markets don't react to noise, they react to triggers. Triggers can come from unexpected inventory draws, delivery bottlenecks, policy shifts affecting mining regions, sudden investment inflows, or even broader financial stress that pushes capital into tangible assets. When a freeze phase ends, it doesn't dissolve slowly, it fractures. Price discovery accelerates because the system no longer has room to absorb imbalance quietly. Bids move higher rapidly, offers thin out, volatility expands, and what once looked calm suddenly looks obvious in hindsight. The real question right now is not whether silver is strong or weak. It's whether the visible calm accurately reflects underlying conditions. History suggests that prolonged stillness during periods of macro instability rarely lasts. The longer compression continues, the more sensitive the structure becomes, and sensitive systems don't need large shocks to move. They need small ones at the wrong time. Freeze phases don't end because everyone agrees it's time. They end because the system runs out of room. At some point, the internal adjustments can't compensate anymore. The balancing act between paper liquidity and physical constraint reaches its limit. And when that happens, the shift is not polite. What makes silver especially vulnerable to sudden repricing is its size. Compared to other major asset markets, silver is relatively small. That means it doesn't take massive capital flows to move it. It takes misalignment at the wrong moment. If industrial users continue absorbing supply quietly, if investment interest begins to return even modestly, if delivery confidence weakens even slightly, those forces can converge very quickly. And here's the critical part: markets don't announce when confidence is about to break. They look stable right up until the second they aren't. During a freeze, volatility feels suppressed, moves lack follow-through, traders grow bored. But boredom is often the final stage before expansion. When volatility compresses long enough, it tends to release with energy. Silver's historical behavior supports this pattern. Extended sideways phases have repeatedly preceded rapid directional bursts, not because sentiment flipped overnight, but because structure shifted underneath price. Right now, if something has changed behind the scenes, the market won't advertise it immediately. Inventory reports don't always tell the full story in real time. Contract exposure doesn't reveal intent. Large players reposition quietly, but price eventually reveals everything. And when it does, the reaction window can be very narrow. Another risk in freeze environments is psychological complacency. Participants anchor to recent behavior. If silver has been range-bound for months, they assume it will continue. Risk models adjust. Expectations normalize. Hedging becomes lighter. That normalization is precisely what makes a breakout disruptive. If silver were screaming higher already, everyone would be alert. If it were collapsing, fear would dominate. But a controlled freeze creates a false sense of predictability. It convinces the market that nothing urgent is developing. Yet historically, silver has rarely stayed dormant during periods of monetary stress for long. Debt expansion continues. Currency uncertainty persists. Industrial dependency grows. Global supply chains remain vulnerable to disruption. These variables don't disappear simply because price feels calm. They accumulate. And when accumulation reaches a threshold, markets reprice to reflect it. The most dangerous phase isn't the breakout itself. It's the period right before it, when most people are convinced there's nothing to worry about. If silver is truly in a freeze, it's likely not random. It may be strategic. It may be structural. It may be temporary compression before expansion. But freezes don't resolve by staying frozen forever. They resolve by breaking. The only question is whether the break will be upward, downward, or violently volatile in both directions. What history suggests, however, is that prolonged compression rarely leads to gentle outcomes. Silver may look still, but stillness in a sensitive market doesn't mean stability. Sometimes it means something changed and we just haven't seen the effect yet, and when we do, it won't feel gradual.